So let's talk a little bit about private equity in Africa. Where do you think are the differences between what we see in terms of private equity in Africa versus in the more mature markets like Europe and the United States?
Well, essentially because there's a very different economic climate in Africa, you are going to have very different strategies for Africa. Particularly where you have very specific funds in Europe and the US on specific industries in specific countries. In Africa, you have to be a bit more broad in terms of your strategy.
Okay.
You have to be a bit more open, both in terms of the instruments and in terms of the industry. That makes a complete difference in the kind of team you have, how you deploy your resources, how you deploy your capital, and therefore it just accompanies the growth of the continent, because it's a continent full of opportunities in terms of consumer services, infrastructure, real estate, and all the services around extractive industries. So very different from Europe, obviously.
Okay. One of the sort of key messages that we came away with last year at the forum was that investing in Africa was patient investing, that if you're looking for a quick return, then Africa wasn't necessarily the place to invest in. How does that work with regards to private equity, who notoriously do want to have a fast turnaround, do want a quick exit, and do want to obviously have the returns on their investments?
Right. I think there's two issues that have to be considered. Number one is the size of the funds.
Okay.
You see lots of smaller funds which are not which are essentially suboptimal.
Yeah.
Because it's normal that on the first time funds you cannot raise big amounts of capital.
Okay.
But it's a bit unfortunate because in fact in our opinion the bigger sized funds, not the huge funds, but the mid-market to bigger sized transaction deals are probably more successful in the future. Because they will be more secure, they will be done with partners which are bigger and more institutional, and therefore you hedge against the risk, the political risk in a bigger transaction. On the other hand, obviously you have many GPs and LPs, particularly which are not used to the risk of a continent such as Africa,
okay,
and which are more used to fast transactions and quicker turnaround in the deals. That's not possible because essentially the economies are not ready for it. You need to find exit strategies, you need to build up your company and for it to reach a certain amount of potential that makes it interesting for a sale. And that takes much longer than in Europe. So I still think it has to be a very patient capital.
Patient capital. Okay, let's just, towards the end of the panel, you spoke about human resources and how challenging it can be. Private equity funds obviously rely on having strong management in the company that helps them turn around the business, develop it the way that private equity wants to do it. How much of a challenge does that pose in a market where you possibly don't have those human resources?
Again, it depends on the industry. You have some industries in Africa which are very well developed, and some of them even more developed than in other parts of the world. Mm-hmm. But for some specific situations, you need that specific expertise that doesn't exist locally. The good news is that there's many African professionals all over the world, and you can try to bring them back to Africa. And many are going back because they see that the growth is in their continent. And obviously, if you can't do that, at least you can always import other Western people which have no jobs anywhere else, and therefore they're very happy to go to Africa and try something new. But it is an issue. I think it's something that has to be taken into account in any investment, because normally things will take longer in Africa. It is also more expensive to run a business in Africa because there's less competition between services, so everything costs more. That means that your returns potentially will be lower. Now that is countered with the fact that you have less competition for the deals, okay, and therefore maybe you can get in at a better price and exit with a bigger return.